Hello, tradeologists. Welcome to Module 11, and this is Explosive Strategy number 2. We're going to talk about flipping stocks. This is a pretty neat strategy, I think, that you're going to find extremely useful in your arsenal for making money in the markets. This is a business strategy that allows me to buy stocks cheaper than anybody else by placing my order in now. And you know what? If the market doesn't cooperate and I don't get to buy my stocks at the price I want, they pay me for just kind of waiting around until the stock does get to my price point. So it's a really neat strategy for a couple of different reasons. Number one is that we get paid regardless of whether the stock hits our price or not that we want to buy it at. Number two, if it does hit our price, then we get into a trade similar to what we did in part 1 of our explosive strategy number 1, which was to purchase stock and then include a protective put, which is basically a covered stock strategy. The covered stock strategy allows you to protect the value of your stock that you purchased by buying a put on the stock so that if it does go down, it doesn't cover 100% of your loss, and there's always risk in the market, so you're not going to get a free trade. Nobody gets free trades in the market. But what it does do is help you offset the cost of the declining stock, a loss of your investment, by having that insurance on your stock and then allowing you, without any additional money into that trade, take the insurance money, the put that you've sold if the stock does decline, and then use that additional funds to buy more stock so that you can leverage your purchase and get additional stock into your portfolio so that when it does make that rise, it does rally again, that you're going to have, sometimes you can have as much as, double the number of stock that you purchased in the beginning in your portfolio, and eventually the stock does rise and you make money. So that is a longer term trade. Now these trades here, this is a kind of a trade that is pretty simple to implement, but don't let the simplicity fool you, because it is a pretty explosive strategy. You can make good money with it, whether the stock hits your price point or not. Let's take a look at an example, and I'll show you exactly what I mean. Citigroup is a banking stock that has really hit some tough times. Let's take a look at a current graph here. This is a 2-year graph. You can see that the stock topped out pretty much right around 53 going back to June of last year, and it's really gotten killed. It's really just dropped dramatically, especially this period between October and November. Boy, it had a huge drop here. Almost 50% of its value was lost. Well, another 50%, another huge amount of value was lost again from November of last year till now, and it looks like another 20-30%. So we've had a huge drop from its highs, and right now it's sitting right around 1930. It was as high as 53 going back to June of 07. Well, at this price, you may find that Citi is particularly attractive. Now, I'm not saying that this is a good strategy to use on Citibank. Remember, just like the explosive strategy number 1 in this module, you only want to buy stocks that you are absolutely sure are going to be, winners for you in the long term. You only want to be able to put the strategy on for stocks that you want to own. If you don't want to own the stock, do not do this strategy. This is a strategy only if you want to own the stock. So if you think Citigroup has gotten hit too hard here, if you feel investors have been over-enthusiastic about selling the stock, and you feel that the Citigroup stock presents to you a long-term competitive advantage in your portfolio, then this is a stock that you might be interested in doing. I'm not recommending Citigroup, though. There's lots of stocks that you could do this on. Let's take a look at Bank of America. Bank of America is another stock that has gotten hit extremely hard in the financial markets, and it's currently trading at $27.10. Unlike Citigroup, though, there is no previous low. Citigroup had a previous low right in here, which is approximately $17.76. So what does that say? Well, you know what? it did rally up from there. It went from $17.76 all the way up to $27, so it did have a slight rally in there, but then it's fallen back down again. Now, there's a strategy that you can use. Let's say you didn't want to jump into the stock right at this point. You could. You could do that. On a stock that's fallen that far, you can see that, you have a number of different options. You can purchase the stock, and you can purchase a covered put for it. Let's just take a look at the $17.50 here. Actually, the $20, I would go with the $20 put, and we'll just go ahead and buy it, just like we did in the strategy number 1. We'd go with covered stock. And I'm going to bump that up to 1,000 shares. And if we go ahead and take a look at an analysis of this, you can see that we would have to put up $30,000 in margin. We'd have $940 in total risk on the downside for the stock. And if the stock moved up a couple bucks, we're going to make about $1,000, and from there, it's pretty much of a free ride. So we could, if we wanted to, we could go even deeper. Go down to $22.50. That gives us a total risk of only $250 on the trade. However, our break even now is a little bit higher. It's up around 22. Let's take a look at that again. If we use the $20 put on 1,000 shares of stock, our total risk is $940, and our break even's right around just under 21. If we go with the more conservative $22.50 put, well, our risk is only $250 at the most on the downside. However, our break even is up around close to the 23 level. So we've raised our break even about 2 points. So, you can be very conservative, or you can be extremely, a little bit more aggressive by buying the lower strike put. Our margin requirement still is $30,000 though for this trade for 1,000 shares. What if instead we did this? Let's say we thought that the prospect of Citibank getting to $17.50 is pretty good, but maybe not that great. Let's say it goes back down below this 18 level, right where this little island here, this little island bar is here, and this is where you figure it would be a very attractive opportunity to purchase just below the bottom of that bar, which is the bottom of this bar is the lowest $17.76. So at $17.50, you feel that it would be a very attractive opportunity. Now, like I said, I am not recommending Citigroup stock. In fact, it's gotten beaten up pretty bad, and it could even fall lower than this. But you felt it was an attractive opportunity to own Citibank, the Citigroup stock, at $17.50. In order to do that, you could simply purchase or simply sell the $17.50 put. If you bought the $17.50 put, you can always exercise that put at any time in the future, because buying a put does allow you to sell that stock at any time in the future. You could buy the call at $17.50, and you can buy that stock at $17.50 at any time in the future up till the expiration of the July options. So if you wanted to, you could simply buy that call. Well, if you bought that call, what's your total exposure? Your total exposure, if you wanted to buy 1,000 shares of stock, so you bought 10 contracts of the $17.50 call, and that gives you the right, but not the obligation, to purchase the stock at $17.50. Now, what happens if the stock moves down to $17.50? Well, at $17.50, if you did want to buy the stock at $17.50, and the stock did move down to $17.50, you'd exercise your option. The problem is that you'd have a loss. You'd have a loss of $2,400, because at expiration, if the price of the stock drops to $17.50, how much is that option worth that you purchased? It's worth absolutely nothing. It's worth zero. So you'd have a total loss of $2,500. Well, I don't think that's a particularly attractive strategy. If you feel the stock is going to move down to $17.50, you do not want to buy the $17.50 call, even though it gives you the right to buy the stock at $17.50. Instead, a more attractive strategy is actually to put on a vertical spread at the 1750 level on the put side. In other words, you would go in here at the 1750 and you would sell a vertical spread. Now this does a couple different things for you. Number one, you can determine the number of shares that you actually want to buy. If you want the stock put to you, that's why they call them puts. If you want the stock put to you at 1750, in other words, you have to buy the stock. If you sell the 1750 put, you would have to buy the stock at 1750. So, number one, you get the stock at the price you want. You get the price of the stock set for you by the option that you sell. If you wanted the stock at $15, well then you would change this. You would change the one that you sold to the $15 level. Now you recognize the fact that when you're selling a vertical spread, you receive a credit for this. Just like we do iron condors, we're selling vertical spreads. We're selling a vertical spread on the call side, and we're selling a vertical spread on the put side. Well, in this case, the only thing that we're doing is selling a vertical spread on the put side because we want to set the level at which we purchase the stock. If we think the stock is going to drop to 1750 and we would be very, very happy to own that stock at 1750, then we sell a put. What happens when you sell a put? Well, it gives the put buyer the right, but not the obligation, to sell the stock at 1750. So by being a seller of that put option, they would, if they exercise their right, and they would do that if the stock dropped to 1750 or below, then you would be obligated to purchase the stock at $17.50. If we wanted to buy the stock at $15, we would sell a $15 put option in order to purchase that stock at $15. Now, we could just sell it. We could just sell that option, but what does that do? Well, just selling the option without a corresponding purchase of another option to protect that position gives us unlimited risk. Well, almost unlimited risk. Let's take a look at the analysis again here. What happens is it allows us, if we sold a put option, it gives us a little bit of premium here, but it also gives us almost unlimited downside risk. I say almost unlimited downside risk because the stock can't go below zero. But it does give us a tremendous amount of risk on the downside if the stock continued lower. So that's why we always protect the sale of a put or sale of a call with an additional call or put to protect our position. So let's say we wanted to purchase the stock at $17.50. We would go ahead and sell a vertical spread at that level. Let's say we wanted to purchase 500 shares at that level. We thought that was a very attractive price. Well, at this level, if we wanted to purchase 500 shares at $17.50, we can enter our order for a put spread to sell the $17.50 and then purchase the $15 puts as protection against that. And here's what happens when we analyze this particular trade. If the stock moves up, we make our maximum profit of $195 on 5 contracts. If in fact the stock drops, what will happen is if it drops below our $17.50 level that we want to purchase, well, guess what? We're going to get that stock at $17.50 if it drops below $17.50 at expiration. But at the same time, we're also going to be protected with the July 15 put. So we will be long 500 shares of Citigroup at $17.50, and then we will have our protective put in place at the $15 level. That does not give us, of course, 100% protection, but it does give us some protection if the stock should move even lower than that. But in the meantime, if the stock does not fall to $17.50 and continues to move up against our position, well, we still make money. Like I said, we get paid for waiting. We get paid for waiting for the stock to drop to 1750. For the month of July and these July expiration, which is about, let's see here, we have 27 days left in July. We would get paid $195 for 27 days just to wait until the stock dropped to our price that we wanted. And it's as simple as that. And if for some reason, let's say somebody who purchased the 1750 puts wanted to exercise their options prior to the expiration date, well, we get to keep the premium. We sold those 1750s for 69 cents. We actually get to keep the premium from that sale, and we would also have the stock at the price that we wanted, if we wanted it at 1750. Now, the reason I say that this is really a strategy, an explosive strategy for people who have a little bit more capital to work with, is that you will have to, if this 1750 put is exercised, you will have to buy the stock at 1750. So if you sold 5 puts at the 1750 level, well, you're going to buy 500 shares at 1750. At 1750 times 500 shares, you're looking at an investment of about $8,750, which is not too bad. Actually, on margin, you'd only have to put up about $4,300. But you'd have the stock at 1750, which is a pretty attractive level. Now let's take a look at another stock. Let's go to BAC. Oh, wait. Before I do that, I just want to point something else out to you. This is a particularly attractive strategy if you want to bottom fish stocks. Rather than purchasing the stock outright, and you wanted to really take a look at a stock that has fallen dramatically, for example, at Citibank. Citibank has fallen dramatically here, and you want to start bottom fishing to see if you can get it at a really good price way down in here. Well, the reason this is an attractive strategy for bottom fishing stocks is because of the volatility. I just want to take a look at the volatility here. The volatility on the July options is 79%. That's the implied volatility. That's relatively high because the stock has fallen so much. What does that mean for the options? Well, the options will be more expensive the higher the implied volatility. So as the volatility increases, it also increases the price of these options. It actually increases the value of both the calls and the puts, but we're only interested in the puts at this time. We can do some analysis here. Let's take, for example, let's go back to our Analyze tab here for a second. We have a vertical here that we can sell the 1750 puts and purchase the 15 put for a credit of 39 cents. What happens to this particular price, the price of this credit spread, if volatility were to decrease? You can see that the vega, the theta, the gamma, and the delta are about 80.73 on the delta. So we're slightly long delta. That means, in other words, that we make more money as the stock increases. Our theta is $3.18. That's how much we expect to collect on a daily basis, getting closer to expiration. And our vega is a minus 369. So in other words, if volatility were to decrease and we're short vega, we would actually make more money. You can see as vega decreases, we would actually make more money as the volatility decreases. Right now it's at 79% for these options. If, in fact, we decreased the volatility, as I'm doing here in this volatility adjustment, by 2%, you can see that already the profit that we would make on a daily basis would increase just slightly. Let me bring that back up to 0 in case you didn't see that. at the current volatility level, you can see that our profit and loss would be a loss of $10 on the day as soon as we put it on this position. But if volatility were to decrease by 2%, now we've only lost $2.86 for this day. So as the price of the stock increases, will also decrease volatility. The reason that we can get this good of a price on these options is because the volatility is at 79%. Now here's another thing to consider. With volatility at 79%, look at the December options. If you go out to the December options, the volatility is only 57%. That's a huge positive skew. Let's say you were interested in owning this stock, but what you really like to do is not only own the stock at $17.50, but have your protection in for a longer period of time. Well, what you could do then is purchase a diagonal. You would purchase a diagonal by selling the July 1750 puts and buying, let's say that we don't want to do September, we want to do the December because it's a lower volatility. The Septembers are still at 71%. But if we go out to December, now our volatility is only 57%. At 57%, we have a positive skew of close to 22% between the July options and the December options. And if we were to do a diagonal on that, our debit would only be 52 cents. We're collecting 66 cents on the sale of these 1750 puts. If the stock goes absolutely nowhere, we make good money based on the sale of these 1750 puts. If the stock declines and we purchase the stock at 1750, well, now we have a long-term option, a December 08 option at $15 as protection. So we get assigned the stock at 1750. We've got 500 shares at $17.50, but we have a long-term put, a December of 08 put at $15. Now that's a very attractive scenario. If the stock stays approximately where it is, right around the $19 level, well, this $17.50 put will expire worthless and we'll collect the entire $300 that we collected when we sold this put. Now what can we do? Well, pretty soon after these July options expire, we'll have August expiration. Because we own a long-term, a long-dated put at the $15 level in December, now we can also sell the August 1750 puts when they become available. Do you see the power of this? The power is that we have a long-dated option, a December option at the $15 level that we own, which we are long. We can sell against that the July option. We can sell against that the August option. We can even go out to September now and sell another set of options. We can go out to October and sell another set of options. In other words, every single month from July to August, September, October, November, we can sell each month another set of options against the 5 that we own in December. We can even, as we get to the December options, because we own those 15 puts, the 15 level puts for December, we can even then turn that into either a credit spread or a debit spread for the December month. In other words, we still own the $15 puts for December. We can sell again the 1750s to create another, the sale of a vertical spread, or we can sell the 1250s and create a debit spread. So we can sell every single month between now and December any of the puts that we want because we are protected by those $15 puts. It turns into a very attractive scenario. So in July, right now we can sell these for 66 cents. Well, as they get closer to expiration, obviously there's going to be no value left in those if the stock remains the same or goes up slightly. The very next option expiration after these July options expire will be August, because they only put the next month option up after the current month expires. And then they have some longer dated options, as you can see here. So after the July options expire, the August options will be available that you can sell again. Now these 5 December $15 puts are going to cost us approximately $1.21, as you can see here. In order to break even on the purchase of this put, we would have to sell approximately 2 months of options. So if this one we purchased, or we sold this in July and we collected 66 cents for it, if we went out to August and we were able to collect another 66 cents and we kept the entire premium without getting put to stock, we've already covered the cost of our $15 put. That $15 put is absolutely free to us now. So in 2 months we could pay for this one put that we purchased if the stock continues to move up. So that means in September and October we could write another set of puts against those $15 December puts, collecting even more money. Not only are we able to collect an income while we're waiting for our stock to get to $17.50, but we have a long-dated option to protect us for any downside risk if we are put to stock. It's a very attractive strategy. Now, you can do this on a single stock or you can do this on multiple stocks. It all depends on how much capital you have to work with. I mentioned Bank of America. Let me ask you a question. Do you think there's a potential for Bank of America to go out of business completely? Think about it. It's either the second or third largest bank in the United States. In fact, it's one of the top banks, the largest banks in the world. How likely is it that they're going to go out of business? Well, not very likely. They're going to be around a long time. If that's the case, then does $27.10 for the price of Bank of America stock look attractive to you? Well, yeah, it might, but let's take a look at a really long-dated chart. Let's go back 20 years. You can see the Bank of America stock has been as low as $12.50 going back to 2001, and even lower than that if we go way, way, way back when it was a much smaller bank. Well, it's had quite a run-up, hasn't it? I mean, if we apply very simple technical analysis to the stock, you can see that it broke through at the $25 level back in the middle of 1998. It hit it, came down, and then broke through back in 2002, and it continued up from there. Now we're getting back close to that $25 level. Well, at that $25 level, that might be a very attractive price for an entry, because in general, what happens is that breakthrough, that area in which the stock broke through, becomes support. Remember, prior resistance usually becomes support. So let's see what we can find at the $25 level. Well, at the $25 level, you can sell a put on Bank of America right now for $1.07. Let's say you were very bullish on the stock and you wanted to sell that, and you wanted to get, if you were put that stock, you would love to own 1,000 shares of the stock. However, if it didn't get to that level, you'd like to be able to collect that money. So at $1.07, we would collect a total of $1,070 minus commissions in order to have the privilege of owning the stock at $25, which you feel is an extremely attractive level to own that stock. Well, look at the volatility again. The volatility is 81%. In other words, if the volatility of this stock was much lower, there is no way that this $25 put is going to be priced at $1.07. In fact, it would be dramatically less if this volatility level was way lower than this. So just like we did with Citibank, let's take a look at a few months in which the volatility is dramatically lower than it is right now. Well, if we go out to August, it's 74%, and it's a slight positive skew. If we go out to November, it's only 58%. That's not too bad. Let's take a look at the 58% levels on the put side at the $25 level or the $22.50 level. Well, we can purchase a diagonal. We're selling the 25 July put, which we collect $1.07 for, and we can purchase, let's go out to the November because that is the lower volatility month, the November's at the 22.50 level, which is only $2.50 below the current level of the put that we're selling, for only 78 cents. Let's take a look at different scenarios, just like we did with Citigroup. Well, we can sell the Julys. If Bank of America stock never drops below $25, we collect that entire $1.07 times 10 contracts is $1,070. We still own the November 22.50 puts, and those we can continue to write against those July options. We sell those for $25.07 at the 25 level in July. When those expire, we go out to August. In August, those $25 puts are probably still going to be around $1. The volatility level is still relatively high, and if they continue to be high, we should get another $1 for that. So we're now collecting $2 in premium against a purchase of a put that is $1.84. Well, even as we go out, we can sell August, we can sell September, and we can sell October. We can sell 2 additional months against our November puts. This particular strategy is very, very attractive to bottom fish stocks. Stocks that have really gotten hit hard, because what it allows you to do is purchase, really purchase the stock not only at an attractive level, but get paid for waiting for the stock to drop to the level that you want to purchase it at. Now, what happens? Let's say in July the stock actually does trade down below $25. Well, if the stock does trade below $25 during the time that you're short these options, you will purchase 1,000 shares of Bank of America at $25. Now remember, we have collected $1.07, which we do not give up. We continue. We are still able to keep that $1,070 for waiting. But we also now have the obligation to purchase this stock at $25. Even if the stock were to fall lower, we would have to purchase it at $25. But remember, we have the 22.50 puts in November to help protect our position. So even if the stock were to fall lower, these will continue to increase in price because we are long these options. And that's a very attractive scenario, because if the stock does continue to drop lower, we're able to cash in our insurance policy, which hopefully has already been paid for or significantly paid for by the sale of the July options, maybe even the sale of the August options. Now this becomes pretty much a free, there's no cost to this put after we've collected over $2 in premium. We have a free put, and it's a long dated put. So we have this put as our protection. If the stock does drop down, we can cash in our insurance policy to purchase additional shares of the stock. And as you know, eventually, the probabilities are, like I mentioned, that the Bank of America is such a large corporation, there's no way that they're going out of business. Even if they did, you still have your 22.50 put that you can cash in. Even if the stock dropped to zero, you would still collect $22.50 on that position. So this is a very, very attractive strategy. especially using the sale of a diagonal position on a long-dated option. The thing that really makes this work very well is the high volatility of the near-month options. If you have extremely high volatility in the near month and you can purchase a lower volatility on the far months, that gives you a tremendous positive skew on the volatilities, and you have a number of months in between that you can continue to sell premium. Now let's say the stock does move up. You own the 2250 puts in November and the stock continues to move up. Well, you have a couple of different choices. You collect the premium on the 25, that expires worthless, so you collect $1,000. You go out to August. If the stock continues to move up, well, maybe you want to sell the 2750 instead of the $25 puts. That means that you would own the stock at 2750 if you were assigned that stock. But it may be an attractive premium, and you feel that at that time it's still attractive to own that stock at 2750. In other words, because you own that long-dated option, the put option, you can write any of these options that you want. You can write the 2250, you can write the 25, you can write the 2750. Wherever, after this July option expires, wherever you feel you'd like to own that stock, you can write a different put option in the subsequent months. In August, after the July expires, you have the August expiration. Then after that, you'll have the September expiration. Then you'll have the October expiration. And then you'll go into the November expiration, in which you can either create a debit spread or another credit spread in the final month of the option expiration. So there's lots of attractive strategies here. Now, does it work for all stocks? Well, it might. This is how it works very well on a stock that declines. It could also work very well on a stock that's going up. Let's take a look at a stock called Enbridge. This stock has been in a long-term uptrend. It's an energy stock, and as you know, most energy stocks have been going up dramatically over the past couple of years. This stock in particular has a very attractive pattern. It's been going up consistently. Let's take a look at the volatility of ENB's options. Well, as you can see, they're not as volatile as the Bank of America or the Citigroup. In fact, the July options have an implied volatility of only 31.72%. However, it does have a positive skew over the next dated option, which is October. In most cases, on individual stocks, you're only going to have the opportunity to purchase or sell the near-dated option, which is the current month expiration of July. Occasionally on larger stocks, you're going to get more number of different months in which you could buy or sell options. But in this case, you have the front month at least, and you have an October of 08, which is 118 days away. You can see that the volatility drops approximately 5% for the October and approximately 8% for the January of 08 options. Now, if you think that this is a particularly attractive stock to own, you might want to take a look at the fact that it is trading at the $44 level, and then take a look at a place at which you would like to potentially own that stock. Well, unfortunately, because the volatility is so low, the actual price of the options that you could sell is almost zero at the $40 level. You'd have to sell the stock at $45, which is approximately $1 in the money, in order to generate any premium income at all. Well, if you were to sell the $45 options, let's do a diagonal, and you were interested in purchasing 500 shares, and you wanted to buy it at $45. Well, it doesn't make really a lot of sense, does it? because you can go out and purchase a stock in the market right now for approximately $44.06. So why would you want to sell the option at $45? Well, if you went ahead and actually took a look at this particular option, you could buy the stock at $45, but you'd have in October a long-dated protective put at $40. Remember, though, that let me just change this to extrinsic value. You're selling and you're receiving 68 cents of extrinsic value. You get to keep that whether or not the stock goes up or down. Actually, you get to keep the entire premium. But since the stock is at $44, there's approximately $1 of intrinsic value in this option. There's only 68 cents of time value in this option. So in reality, you are buying the stock for $44.06 because you have $68 of extrinsic value if you sell this option. Now, if the stock continued to move up, you would continue to collect that entire $1.50 of premium. If the stock were to move down, this particular option would increase in value. You would buy the stock at $45, but you'd still have your long-dated October 40 put as protection against the stock that was put to you. This can be an attractive strategy if you like to collect premium on stocks that are rising, and they have a positive skew between the months that you're selling and the months that you're buying. So that's another way to take a look at it. My preference, and I'll show you one that I did, was on Starbucks, which I find to be in a particularly attractive scenario. It has reached some low-term support right around the $16 level and started trading up. Well, I would have loved to have owned the stock at around $15, which was just below this previous bar. I don't know if it'll show you now because this was a few months ago, but the volatility level of the July options was closer to 55%. Because the stock has moved up, the volatility has dropped down to about 39%. So this is not a particularly attractive strategy. If you wanted to own Starbucks stocks now at $16 while it's trading at $17.23 because the volatility has dropped, these options are not as expensive as they used to be. And in fact, there is a negative skew on the options now that the stock has moved up. The option volatility of these options has fallen by 20%, and the longer dated October options are 42%. So you have a negative skew of close to 3%. So this is not an attractive strategy to use on a stock that has already started moving up. I would much rather use it on something like Citigroup, Bank of America, or other stock that has fallen dramatically in which the implied volatility has risen dramatically. So what's a good strategy for Starbucks if you wanted to purchase Starbucks now and wanted to get paid for waiting? Well, the only strategy that I would use is by just simply purchasing the stock and using a covered call strategy. Because the volatility is low, you're not paying as much for your puts now. Do you see the difference? Because now that the volatility is low on the front dated month of these options, your insurance cost is going to be less expensive. That's a very, very important detail that you need to keep in mind, is that when volatility is low, that means the market is not pricing the probabilities of a sharp drop in the stock, and you can purchase your insurance at a much lower cost. So now if we were to purchase covered stock, and that's the only strategy I would use for Starbucks here, Let's analyze that as a duplicate trade. And let's say the stock is currently trading at around $17. So we'd want to go a little bit further in the money here just to get a just to be a little bit more protective. We can purchase 1,000 shares at by using the 1750 put, which has an implied volatility of only 34%, and our total risk at this point of 1,000 shares of stock is only $540. If you only wanted to purchase 500 shares, the total risk is $270. And where's our break even? Well, our break even is just about $18. If we wanted to go even further in the money at the $18, well, I don't have an $18. Let's go $19. Now our break even is all the way up to $19 and approximately 10 cents. But our total risk on the trade is only $65 with unlimited upside potential. So you see, this is a particularly attractive strategy when volatility is low on the options that you want to purchase for insurance. But it's not a particularly attractive strategy if we wanted to sell these options to create income and purchase a stock at a particularly attractive price like we did with Citibank. Go back to Citibank for a second. Those July options are 79% implied volatility, which is relatively high, and the options are priced accordingly. They are more expensive. So now, if we wanted to go ahead and purchase these options as insurance policies against stock that we're buying, we're paying a fairly decent premium for this insurance because the implied volatility is so high. If this volatility was down to 34% like they are with Starbucks, well, the 1750 being almost $2 out of the money on the stock is only going to be worth about 20 cents. So that's why it's very attractive to sell this option against a longer term dated option or even against an option that's in the same month in order to collect those premiums. I hope you see how explosive this particular strategy is, because you get paid to wait while the stock drops to the price that you'd like to buy it. And using a long dated option at a lower volatility helps you collect premium month after month after month until you get to the date of your long dated put that you purchased. So you get paid to wait, and you get the stock at the price you want, with built-in protection that you don't have to pay for again. And hopefully you'll have collected enough premium over July, August, September, and October, if you were to purchase the December options, that put actually not only did not cost you anything, but actually made you some money as well. So I hope you find this a particularly attractive strategy. Just remember that if you do sell a put, the potential for being assigned that stock is very real, and you could get assigned that stock at any time. So you have to have an account in which you'd have enough capital on margin or in cash to be able to purchase the shares of the stock that you want. If you sold 10 of these options, you'd have to be prepared to buy 1,000 shares of that stock. If you sold 5 of these options, you would have to have enough capital in order to purchase 500 shares of that stock. But this is a very, very attractive strategy. We want to go ahead and buy diagonals. There we go. It's a very attractive strategy. If you want to use it, especially on the longer dated options, you'll find it very, very attractive. And it can build your wealth while you're waiting to get stock at the price you want to buy it at. That's it for this strategy. Hey, stay tuned, guys. I've got another strategy for you I'd like to discuss, and that's an explosive strategy number 3. Trade with confidence.